Long before centralized banking, kings borrowed money the old-fashioned way, from wealthy merchants, nobles, or financiers. If a monarch failed to repay, creditors lost money. Defaults were common, loans were risky, and governments had no guarantee of continuity. Debt was temporary, and the system reset naturally. Everything changed in 1694 when William Paterson, a Scottish merchant, proposed a revolutionary idea. England was at war with France. King William III needed money urgently. Tax revenues were insufficient, and traditional lenders refused loans. Paterson suggested that the government borrow permanently, never repaying the principal, and pay interest forever. To manage this, Paterson created the Bank of England. Wealthy merchants contributed gold to the bank, which then lent it to the government. In return, the government promised to pay annual interest indefinitely. Merchants accepted because Parliament guaranteed payments. Banknotes issued by the bank could be traded, often valued higher than coins as they carried guaranteed interest. This innovation made debt permanent, profitable, and transferable. The government could borrow without worrying about repayment. Taxes would cover interest, flowing indefinitely to financiers. Debt became money. The more the government borrowed, the more money circulated. Citizens funded it unknowingly. Within 50 years, major European powers adopted this model. France issued the Bond Général, the Netherlands formalized state debt, and the United States under Alexander Hamilton copied the Bank of England. Government debt was no longer a temporary problem. It was a permanent feature of financial governance. Interest payments guaranteed perpetual income for lenders. £1 million at 8% interest yielded £80,000 annually forever. Even without principal repayment, loans were valuable, tradable, and created wealth for financiers while transferring costs to taxpayers. Debt became an asset, generating revenue across generations. By the 18th century, the Bank of England had set the template: perpetual national debt, interest forever, and money created from government IOUs. Governments borrowed for wars, infrastructure, and administration, while citizens carried the invisible burden of permanent interest. By the 19th century, Europe's debt system evolved further. Enter Nathan Rothschild. Born in Frankfurt, Rothschild and his brothers established banks in London, Paris, Frankfurt, Vienna, and Naples. Their network could move money across borders faster than any government. Nathan Rothschild industrialized sovereign debt. He bought government bonds at a discount and resold them to investors, creating a secondary market. Governments got immediate funding, Rothschild collected the spread, and investors received tradable assets. He went further. Information became power. In 1815, at the Battle of Waterloo, Nathan Rothschild learned of Napoleon's defeat before London's official channels. He first sold British bonds, causing panic. Once prices collapsed, he bought massive amounts cheaply. When the news of victory arrived, bond prices surged. The Rothschilds profited immensely, not just from loans, but from controlling information and markets. This model trapped governments. Sovereign debt became interconnected globally. Defaulting could collapse entire financial networks. A British bond might be owned by a French investor, then sold to a German bank, then used as collateral in Austria. The web of debt made default nearly impossible. Governments had to borrow continuously to pay interest on existing debt, reinforcing the trap. By the mid-1800s, the Rothschilds were wealthier than kings. Their wealth came not from production, but from perpetual interest on government debt. The system designed by Paterson became global, industrialized, and nearly inescapable. Every European government borrowed, rolled over debt, and paid interest, while the Rothschild network controlled issuance and distribution. America's financial system entered the trap in the early 20th century. Banks operated independently, currency was gold-based, and there was no central mechanism to manage debt. J.P. Morgan acted during the panic of 1907, organizing a private bailout to stabilize banks. Morgan realized the solution: a central bank. Secret meetings in 1910 on Jekyll Island designed the Federal Reserve System. Officially public, decentralized, and presidentially overseen, it was privately controlled by major banks. The Fed could create money and buy government bonds, guaranteeing unlimited demand for debt. Governments could borrow endlessly, pay interest perpetually, and never repay principal. By the 1970s, debt was global and interconnected. Paul Volcker, as Fed chairman, raised interest rates to combat inflation. Developing nations with loans at low rates suddenly faced unsustainable interest. Mexico, Brazil, and Argentina defaulted. Rather than allowing markets to reset, the IMF intervened. Loans were restructured, not forgiven. Nations remained in perpetual debt, often sacrificing sovereignty for continued payments. Today, global debt exceeds $315 trillion. Governments, corporations, and households owe money that will never be fully repaid, while interest flows upward to financial institutions like BlackRock, Vanguard, and State Street. Taxes fund perpetual interest payments. Debt is now a global mechanism of control. The system is complete. Governments borrow forever, pay interest eternally, and institutions profit continuously. Patterson made debt permanent, Rothschild global, Morgan infinite, and Volcker inescapable. 4 architects, 3 centuries, 1 system. The world owes itself, but power resides with those who manage the debt. Debt is not a problem, it is the foundation, and interest is the rent humanity pays to live within it.